mode.
Hi everybody, welcome to the webinar. I'm just waiting for the rest of the people to attend. It's nice to see a lot of you here. Sorry about the previous week. There was some technical issues with the GoToWebinar software, and I couldn't get it to start. Sorry about the date on the slide as well. But this will be the part 5 repeat of trading strategies. Just let me know that you can hear my voice, see the screen, type into your chat box or your question box, and we'll wait until 9 o'clock and we'll kick things off. Hi Francois, it's nice to see you in here again. Nice to see you, Ben, Denford, Milford, Peter, Sibasiso, lots more as well. I need to know that all of you can hear my voice. It's nice and clear, not too loud, and you can see the screen. So everybody just type into your question box, your chat box, and let me know that everything is okay. Wonderful. Great, it's looking like everything's okay, looking like the software's working tonight, which is fantastic. Why not? Let's get things started a little bit early. I can always send out the recording later on to people, late shower-uppers. But for you guys that are in here, it's fantastic to have you back again. And I hope that the trading's been going good. I know that the last few weeks have been hell, thanks to Draghi and thanks to the non-farm, and the other night, thank you very much to the US dollar. Managed to pick up some nice pips, some nice dollars on shorting on the pound. I hope your trading has been going well as well. Okay, let's move on, and as usual, before any webinar, there's a disclaimer. You can use the information I provide you for your personal strategies, but please don't take it as the Holy Bible, because I've been doing it for many years, over 20 years now, and I do make a living from it. And I do also work for a very reputable company, CM Trading. Wonderful company, wonderful people, and I'm glad to have you all there as clients. Just to say, this disclaimer is just stating that information provided carries risk, as all CFDs, as Forex does. We all know what a hell of a market it can be. We can make a hell of a lot of money, or we can lose a lot of money if we don't get our rules, our trading rules, 100%. So moving on, I just wanted to briefly touch up on what we were going over the other week, and this is not my strategy. This is something that I saw a trader using, and it does incorporate the Heikin-Ashi, which is, I've been using it for a long time now, and I don't cover my charts in millions of indicators. I just use the basics. Maybe I'm going to use moving average. Maybe I'm going to, I always use the stochastic with the Heikin-Ashi. It works very well. And Heikin-Ashi is a very visual indicator. It's either in this example blue for a bull candle or red for bearish. Normally people are using green and red just to signify the different movements. So I mean, looking at this example, it seems to work in most time frames. I've checked it. I'm going to show you some examples at the end of the webinar for pound, for euro, dollar, and for gold. These are the three things I seem to trade the most, as well as holding stocks and some other instruments as well, some indices. I love to trade the FTSE. There's great movement in there. All the equities seem to be pushing up, but it does seem as though something is going to happen in the near future. We're just waiting for the US to make its mind up when they're going to actually deliver the bombshell, and this is the interest rates and monetary policies. Just waiting to see what's going to happen there as what to do with my portfolio. So in this example, it seems like we're going to use a cross on an EMA. We're waiting for a pullback. I'll highlight the areas which I'm talking about. Highlight with a pen. It seems as though we're waiting for the cross here, and we're waiting for the pullback here. Now, the pullback is basically we're waiting for the candles to come inside of the exponential moving averages. This is EMA, exponential moving averages. We're waiting for it to enter and to touch both, and then we're entering in a long direction, as you can see from this instruction here. So we're entering long, and as long as the price action, it stays consistent and continues to move above and out of the way of the moving averages, then we know we're good to stay in the position. If you combine it with Heikin-Ashi strategy, then you're looking for an exit on the first red candle, which is roughly this candle here, if you're using Heikin-Ashi, or if you're waiting for the price action to come back and to touch both moving averages again. So we're waiting for, I believe it's going to be around this point here, if you can see that. I'll see if I can highlight it. I'll use a highlighter. We're waiting for roughly this point here to exit when the price action is coming back and touching. So it's a nice strategy for entry, a nice strategy for exit. In combination with using the Heikin-Ashi candles, I think it works very well. It might not be a cup of tea, but I know a lot of traders that are making money using this. And don't forget, it also really matters which instrument you're trading. If you're trading something like the DAX, which is dynamite and can blow up at any point, then maybe this strategy is not going to work out for you. But something stable like a currency, it seems to work pretty well. I've tested it a little bit, and it seems to work quite nicely. So we'll move on to the next slide. Just let me switch back to normal. Okay, now I put down some rules for you. Trading rules for use with EMAs. If anybody wants the slides, by the way, just let me know. I'm sorry I haven't sent them out before. Just been a bit busy and lost track of time. But basically the rules are when the 9 and the 18 to the upside, wait for the price to rally away from the EMA lines. It means to stay above the lines. After a while you'll see the bearish Heikin-Ashi, everything which I've told you in the previous slides. I will you will be able to pause the recording. I'll make sure everybody gets the recording. Pause it here, take a look at the rules. You know, you have the rules for entering long, which are the buy trading rules, and you also have the rules for entering short. I think this strategy will work out very nicely for some of you. I don't know all your trading strategies. Maybe your intraday, intra-week. I just seem to, you know, look at what the market conditions are and try to adjust. I don't stick to the same routine all of the time. It gets stale, and this is when you lose money. Okay. Trade size, I've been over this with you many times. You know, if you're used to entering a trade of one lot, you know, don't enter the whole one lot at once. You know, dip your toe into the water. Test that your prediction, your trade analysis, your technical analysis is good. Enter at 1/5 of your normal trade size. So you're going to enter at roughly two minis if your normal entry is one lot, and you're going to build your trade size as the market moves in your direction. You know, sometimes there'll be pullback, but you know, if your technical analysis is solid and you're following the rules of the Heikin-Ashi and EMA, then you know you can follow either with stop loss as you're moving it up. So you know you're locking in the profit of the first trade. If you're entering with a second portion of your trade, if the market pulls back, you still have the first portion of your trade in profit, and you can exit both roughly at zero. This is a portion of the hedging strategy which I wanted to mention to you. You know, the main hedging strategy is obviously entering with a buy and a sell on an instrument at different volume sizes in order to allow you at some point to exit the trade if you make a mistake on the first leg, which I'll go into later, don't worry. I will send out the slides, yes, Denford, no problem. I've got your email address, no problem. Just send me an email address as well, just to remind me if I don't get the slides out to you. But you will have this recording, so you can pause all of the slides, take a look at you know what I'm talking about again. You know, go over and over and over again, rehearse, and this market's all about you know, repeatability. You know, if you're good at repeating good moves, finding good entry points and good exits, then you're going to be successful. Even if you're only making 5 out of 5 trades, 50% success rate, if your risk and reward ratio, which in the hedging strategy I'll show you, if it's in the correct way, then the market will give you money. It won't take you money. Sometimes you will have losses, but that's life, you know. Move on and open up your next trade. These are the 3 steps for entry. You know, I showed you in the earlier webinars, picking the primary direction, which is on a high time frame chart, normally weekly, daily. You know, identify the slope. Use a 21 period moving average, last Heikin-Ashi bar and price relation to the exponential moving average must match the direction. That's very important. And then confirm it with the stochastic, which you have on your chart. You know, if you use this strategy, you know, you can get around 75 to 80%, but your rules, you have to stick to the rules. Now, we're going to move on to the hedging strategy. Now, this is not cutting hedges. This is, I thought I'd just have a laugh with you here and do this. But this is actually, we're going to move on to trying to make some money. Now, as I mentioned earlier, hedging strategy is the best way to understand it is to think of it as insurance. You know, if you make the wrong decision, then the insurance is that you know which volume to open up with the next leg of your trade, and if it hits your take profit, you always come out ahead of the market. This is your insurance. When people decide to hedge, they are insuring themselves against negative event. This doesn't prevent a negative event from happening because you can't control the markets, but if it does happen and you're properly hedged and you have all your rules in place, you're going to reduce the impact of the event on your trading. Non-farm payrolls, for instance, I did a chart for marketing. They asked me to do it every month. The market moved within, I think, 5 to 10 minutes over 50 pips. The entire move was around 150. It's just a crazy movement. Some people, refer to it as roulette. It's either black or red, up or down. If you get on the right side of that, you can make a lot of money. If you get on the wrong side of it, then you're in trouble if you only have a small account. The hedging strategy, it doesn't really matter what you're doing. If the non-farm payroll goes against you, then you have one side of the trade that's going to be either hitting it first time, or the second, if it's the second leg and the market goes against you, your second leg take profit will take out the whole entire series. Or even if you get to the fifth leg of your hedging, you're going to take out a small profit. So imagine 5 trades, and it does matter what size account you have here, because you have to carry the margin over. So as the number of legs happen, then it's going to increase the margin in your account. So you have to have a decent sized account. You can't be doing a hedging strategy with $500. It's just a waste of time, because you need money, you need margin to fuel your trading. Hedging strategy: analyze risk. Look at what you're getting into. Identify the implications of making the wrong decision and hedging. Determine the risk tolerance. Determine forex hedging strategy, as we talked about. Implement and monitor your strategy. Make sure it works. If it doesn't work or you're getting something wrong, go to a demo. Practice. I can't tell you enough how many times I've gone over that with people. Don't do it with your real money if you don't know what you're doing. This is why you have me to try to go over the things with you. You have your account managers that will help you with your trading. Don't feel like you're alone. Don't go back to the days of when I started picking my stocks from a newspaper, sitting in a cafe on my own, and having really bad charting programs. They were non-existent when I first started. Now you have wonderful MT4 and many other platforms that you can do your analysis on. So you're not on your own. And if you don't know what you're doing, get in touch with us. Get in touch with the account manager. Send me an email. Be glad to help you. No problem. Any questions at the moment from you guys? I see we've got many people now. It's nice to see you all here. Zamile, Sibusiso, Salati, Fakamisa, Peter Milford, Luvengo, Kenneth. I can go on and go on and go on. Any questions from you guys? Give you 30 seconds just to type in. Francois, you normally have a question or two in your head, or is everything okay? Okay, looks like everybody's tickety-boo and drinking on their cup of tea, eating their biscuits. Still battling with entry and exit points. Yeah, I know what you mean, Francois. It's difficult to to pull the trigger. It's hard-earned money, and it doesn't get any easier. Trust me. But if you don't have an open trade, you can't make money. That's my reasoning behind it. Question from Gerhard. How do you identify different market conditions? Flat, trending, range bound? Well, my advice here, Gerhard, is to always start with a high time frame. It's either to go to a weekly, go to a daily, And I call it the primary direction. I don't call it a trend. So I'm looking for, you know, the obvious. I'm looking for, if it's a downtrend, I'm looking for lower lows, lower highs. You know, join them up with the trend line. Create yourself a channel. Channels are the most important thing in trading. Identifying a range, you can make thousands of dollars, even if it's only 20 pips. You can make thousands and thousands of dollars if you identify the right range. But what you do, Gerhard, is identify the range on a high time frame. On a daily, put your horizontals on there, or your trend lines. Move down to a 4-hour, put them in on there, but in a different color. You know, so you know which ones are your daily, you know which ones are your 4-hour. Move to an hour, put some more in on there, and change the color again. Then what you'll do then is, if you like to do 15-minute trading, you know, maybe some scalping, some intraday trading, 15 minutes, 30 minutes, 1 hour trading, then you have all of the channels, all of the trending channels in place. So you know there's a strong chance that the market's going to, if it's at the top of your range, it's either going to break out, keep going up, or it's going to test high and fail and move back down to the bottom of that channel. Also, Fibonacci, a big favorite of mine. I love to measure pullback. I love to see, you know, is it going to break the 50%? As I said, I'm trading gold, so, you know, gold was at a very interesting point until the US dollar came along and kicked its ass. But you know, it moved down to a very low level now. We're moving back down again. Let's see. Anton, nice to see you in here. Would you use a lower time frame to enter? Of course, would be my answer. I use many different time frames. In the morning, my favorite time to trade in the morning is on the pound against the dollar, and it's normally between 5:30 in the morning until 7, and I use pivot points for my pound trading. I look for something called a high test, which is, you know, a test high on a pivot, and then I'm looking for a very small amount of pips because my position size is very, very big. You know, I have a big account, managed account for people, you know, and I have good money to play with there, so I can have a very big position size. So yeah, small time frames, very, very good. You know, even I tend not to go lower than 15 minutes. I think it's a waste of time. The charts are messy. The stochastic, if you're using one, it's inaccurate because it's moving too fast. So, you know, if you're going to go really, really low to a 1 minute, then, you know, I think you're going to struggle. Better to keep it around 15 minutes, Anton. You know, it's the best thing to do. Then third, how do you trade fundamentals and technical analysis together on entry points? Well, fundamentals, if you're talking about non-farm, then, you know, it's very, very difficult to trade an event. What I tend to do on non-farm, if I'm going to trade it, is I look at what the previous month's data was, what the ADP was before the non-farm. I listen to what's gone on during the week, you know, how Draghi talked. Was he positive? Was he not positive? And I tend to pick a direction. If not, you can always open up a hedge, and whichever way the market goes, you know, if you think it's going to go up, have a slightly larger volume size. If you're used to doing, I don't know, half a lot, then make sure that you're half a lot long and maybe half of that short, so 0.25 short. So you have, you know, you're trying to always reduce risk here. Have a take profit if you're going to move to the upside. If it moves to the downside, you don't lose the whole position. You know, think about it like that. That's how I would handle the fundamentals. But for things such as GDP and primary manager indexes, things like this, then, you know, they're more predictable. You know, if we know if the GDP is higher, that it's going to have a good effect on the currency. But most times the GDPs, they're very small changes. The big ones that hit us are the FOMC minutes, the non-farm, central banker speaking, you know, these are the ones that can really sway the market. I feel that there's something very, very big going to happen in the market. It's going to probably come from the States with the interest rates. We can see the performance of stocks. We can see how the dollar is behaving from the dollar index. You know, I would definitely recommend to you guys to have a dollar index chart open on your screen. Also to have the VIX open on your screen as well. The VIX is the fear index. You know, we should be looking at market fear. It's us guys that actually create the liquidity in the market. We are putting volume into the market. So looking at the VIX, if there's a lot of market fear and the VIX goes above 15, then we know that, you know, something big is on the horizon. There's going to be a big move happening, and I'll go into that another day, and I'll show you how the VIX can be used to test the market, you know, looking for big moves. But the dollar index is very good looking at the dollar itself, isolation. Is it getting stronger? Is it getting weaker? You can see after the FOMC that the dollar index went from 96 to I think 97.5, which is massive for the dollar index. So this is a great way of actually feeling out the dollar. Okay, let's whip through these slides because I want to show you some examples of hedging strategies. Okay, 5 rules of the hedge. I'll leave this on the screen for 10 seconds. I don't want to go through every single slide and every single point. So you can pause the slide at these points. You know, we went over what a hedge was. We went over our understanding what the markets, and as I said before, it's not the Holy Grail, not the Bible. You know, we're just traders at the end of the day. Doesn't matter if we have 50 years experience. If we're stupid with our money and we create a lot of risk, a lot of volume, then the chances are we're going to blow our account out. You know, I've done it a few times myself. It's not nice. Nobody likes to lose money, and this is why I'm showing you this, because this will not always work for you, but 6 or 7 times out of 10 you'll be coming out with small profits. If you choose the wrong direction, and in this example this is a hedge. First part of the hedge is a long position, and it is one lot, and as you can see, the one lot, the reason this works is because the take profit is the same distance. I'll just highlight for you. The take profit is 150, and we're starting off at one lot. Now, if the market goes halfway up here and doesn't hit our take profit, then it comes back again. Then we're opening another trade here at this point, and this is what we call the zone. This is our buffer, our safety zone, 50 pip safety zone. We're going to open up another trade if the market goes here. So if it pulls back, goes into the zone, we're opening a position, but at a slightly larger volume size. So if the market hits 150 pips here, we come out with more money than we would. So we're 1.4 short and we're one lot long. So we're 0.4 short net. So by the time it does 150 pips, 0.4 short net would give us a positive amount of dollars here. Silati. When hedging, must the lot size be the same? Okay, well, we're going into that now. No, absolutely not. What would be the point in me opening one lot long and then opening one lot short? You would still be losing. If we did 150 pips and it was one lot long, one lot short, then we would only be $1,500 profit. If it went bad, it would be $1,500 loss. Well, it'd be $1,500 profit on this trade, but we would actually be $2,000 because we have 50 pips. So we have the 150 plus the 50. We would be $2,000 loss on the long position and $1,500, $1,400, I apologize, for this position, this leg. Now, if the market, once again, this is our second leg, if the market goes bad and doesn't, it doesn't go beyond here, and it starts to move back again, then we're opening another position on our first entry. So we're already one lot long. We would open up 0.93. So we would be 1.93 long and 1.4 short. 1.93 times 150 would give us a slight profit on 1.4 times 200. So we would be making a small profit on 1.93. 1.93, I don't have a calculator, but I guarantee you it's a worked out strategy. It does work. Take the slide and pause it. Try it inside of your demo. Now, as a trader of many, many years, the furthest I ever got into this series, my trade sizes are a bit bigger than this. I'm normally around the 4 or 5 lot entries, and then I build my trade. Sometimes I end up with 10 lots of pound, but as I said, it's a big account and it can handle it. What we must try to always have in our heads is a money management strategy. If you're using $1,000 to trade with, then you should not be opening up more than 10% of that in margin. So one lot of euro dollar, it's going to be more than 10% of your margin. If you're on 400 leverage, maybe you can get away with it. 200 leverage, you're going to be using around $400 to $500 in margin. So always think of this rule: 10%, no more than 10% in margin, and you'll be okay. Now, if you do end up going into the fourth leg, then you can see that the volume size, Salati, it changes again. So if you add the two volumes here, the 1.4 and the 1.24, then we will be 2.64 short, and we will be 1.93 long. Now, if you do your maths, I guarantee you by the time it gets to 150 pips, and if it hits your take profits, the whole series of trades will close down and you will make money. Now that is after 4 trades, and your margin level is it's starting to build. The more margin you use, the more money you've got to have in your account. So you're 1.93 long and you're 2.64. If you minus the 2, that's going to roughly give you around 0.7. So can you see excuse me, can you see how you're not endangering with margin your account? You're roughly keeping the exposure to around 0.7. Now it's a very good way of managing the account. If you do go on to 4, 5, 6 legs, then you should be thinking to yourself, it's stuck in a range. It's going sideways. This is the worst scenario for hedging. Is if it's going to continue to go sideways, you're going to end up with multiple legs on your trades, and it's not what you want. So try not to go beyond, I think on this strategy, 7 legs, and believe me, your margin is going to be approaching a 1.5 lot area. So I'll get rid of these drawings and move on to the next slide. Another strategy here, as you can see, using different TP, using different take profit, 60 pips on this. You can see that initially you have a one lot entry short. I'll highlight it. So this is going to be your first leg, and you're looking for 60 pips. Oh, sorry, you're looking for 127. I apologize. 127. You're looking for your trade to hit. If it goes back in through your 60 pip, this time it is a 60 pip zone, This is not my trading strategy. It's something that I know some people are using. 60 pip buffer zone. You're going from opening a 1 lot short trade to opening 3 lots long. So you're ending up with, you're switching direction completely. You're 2 lots long at this point, net. If the trade goes against you again, you're opening 7. Now, it's insanity really, because you're increasing so much risk inside of your account that it can get dangerous. I mean, who the hell is going to open up 131 whatever? If you're using minis, you're still talking 13 lots here. It's enormous, but you can translate these numbers into much smaller amounts. You can start off with a micro, start off with 1 micro or a mini, 3 minis, 7 minis, 15 minis, 1.5 lot, 3.2 lot, 6.5, 13. It does work. I've tested it, so I know it works. So that's another strategy that somebody's using. Is this generally only for scalping? Absolutely not. You can widen your take profit zones. You can widen your buffer zone. It can be used as a long-term strategy. The problem with actually switching to long-term is that we have to pay swap fees, and it can get expensive. If that market is going to keep bouncing and going sideways, and we have, I don't know, 15, 20 lots exposure net, then your swap fees are going to be horrendous. So my advice is, if you're going to be hedging, is keep it intraday. I like to keep it intra-week. I'm a Tuesday to Thursday trader. I don't touch Mondays or Fridays, not unless I see something that's really mouth-watering, such as the gold the other week. This drew me into a trade, a successful trade on gold. So no, it's definitely, Gerhard, it's not just for scalping. It's for many that you can adapt it. This is the beauty of trading. I'll just get rid of this drawings here. 1 second. Erase. There we go. Another example. You can see that please pause the slides when you're reviewing the video. You can see that the volume sizes are much more manageable. Buy 0.1, sell 0.3. It's giving you a great example of your profit at the end of this series of I believe it's 3 trades. So you're actually, by the time you finish your leg here, you're actually 0.7 long and 0.3 short, which will give you $210 profit and 180 loss, which gives you a net of $30. So it's a great way of managing the account. I know a lot of you, you pick a direction. You're very stubborn. You see the market. If you buy, it goes against you. It starts to go down. You sell as you think, wow, that's a great price. I still think it's going to go up. So you enter more volume, and it goes down. Yeah, wow, this is great. I'm going to enter another trade. By the time you realize, I think I'm in a bad trade, you can be 4 or 5 trades into a series, and they're all in one direction. Now, I don't know about you guys, but I prefer to use a strategy like this, which gives me an equal opportunity to try to get out of a bad trade, rather than keep loading risk into my account. So, this is what professional traders do. This is what we do on trading floors. I was working on exchange, trading stocks, so I know about exposure, I know about risk, I know about hedging, and the big boys, the big companies, you can bet your bottom dollar that they don't enter all at once. They enter very large positions for short amount of times. This is why you see spikes in the market, and they make money like this. So this is another little series here. We can see that First entry was a mini lot long, and second entry was 3 minutes short. And the 3 minutes short, the take profit hit, which gave a profit of 90 and a loss of 60, which gives a net of 30. I think you'll agree again. You know, you'd be happy with $30 from a trade if you're trading on a $1,000 account, 10 of them, and you're looking at you know, nice profits, you know, inside of your account, triple your account if you do that over the month. Next example, this is what I call the whole process as I've been through on the slides with you. Identify what exposure you're going to use, formulate your risk management, you know, how big is your buffer zone, determine how much money you've got in your account, your budget rates, and what expectations you have. Get your hedging strategy, practice and more practice, execute it, look at your results. If you're not making money, dump the strategy and try something else. And that's what you should be doing every time you try something new. This is what I do anyway. I go around and round until I find something. A little refresher here on how to identify trends. This particular box here, which I'm going to highlight for you. This particular box here, we're trying to highlight a possible master trend, primary direction. So this is the high time frame. We can see that, you know, this particular portion of the chart is a trend, a bear trend, and then we start to see the reversal. You know, Fibonacci, this is around the 50% retracement. Is it going to bounce and go down, or is it going to break and go up? This is what, as a trader, we're looking at, you know. Then we're moving down to this one here, and again looking at the trend. This is a shorter time frame, and we can see that there's a nice uptrend developing. It's above the moving average, you know, price is above. This is a short-term trend, and then we're moving on to I think this is 5 minutes, euro dollar, and this is identifying the changing colors of the candles. So, you know, Heikin-Ashi works very well. I'm going to show you on a live chart very shortly. I'll just erase the drawings. And I think we went over this slide as well in the previous episode. Entering the hedge, the original trade here at the top of the range. So, you know, entering the hedge here, exiting down here. You know, we're looking for color change, and we're looking for a cross of stochastic, which I'll show you on my charts. You can't really see it very well. It's not such a great example. Okay, just switch to normal. Okay, same chart. We're looking at exiting, as you can see on the chart, trade with profit. So we're looking at the volume levels working for us, and we're looking at the take profit area, and we're looking at getting out of the whole series. If with 5 trades, I want to get out of all 5. I want them all to shut all at once. So, you know, I don't want to be stuck in a trade. This strategy is protective. It's going to look after your money, I guarantee it. And you could, if you're good at it and you practice very well, achieve 70 to 90% trade prediction. So I'll show you on my chart. It's the end of the show. I'll show you on mine, and we're going to look at pound. Okay, I'll just wait for the screen to change. Okay, this is Heikin-Ashi. I'll get rid of the Japanese candles. I mean, if I switch to a daily, it gives us a very, very nice story. It gives us, you know, we can identify what's going on here. I've drawn on my chart, you know, range, horizontal ranges. These are all of the purple lines. These are all of these purple lines. This is a range. This is a range. This is a range. This is a range. and I'll show you, I'll flip down to a lower time frame. But you know, all in all, this block here, this is sideways. You know, the market's going sideways. It's predictable. You know, if we switch down from the daily, which I'll show you, if we switch down from the daily, you know, looking at what who was it that asked me the question for scalping? I don't know, there's lots of questions in there. Anyway, somebody asked me the question, is it just used for scalping? Now, if we were going to use it for scalping, then the beauty of this is I've identified all my daily ranges. If I flip it down to 15 minutes, look at that. I mean, we have the trend line. I'll get my highlighter back. 15-minute Heikin-Ashi. I'm looking for, you know, let's look back at the best entry. The best entry for me is where it's at the bottom of the range. That's the first. We need three things to confirm entry. Second is the stochastic, the cross of the blue line, and where the price is near the 20 area on the stochastic. This is number two. And we're waiting for color change. You know, first white candle, second white candle. And I also put on here for you a 9 and an 18 period moving average. And the cross actually happened here. So, you know, the three things here: color change, entry here, exit on the first red Heikin-Ashi candle, which would be this one, which if I measure for you, let's see how many pips that trade would have made. 1 second, I just have to keep playing around with the webinar settings. If we'd have actually got in, I mean, I would have been looking at entry around this area here, the first white candle. Let's say that we didn't get in on the first white candle, that we waited, you know, just to confirm that the market was moving up, and we do that by looking at the moving averages. The price is above the moving average, and we're looking for an entry here. Okay, so we entered somewhere around here at 15.45, and we exited on the pullback, the first red candle. It's roughly around 22 pips. Now, bear with me, it's only 15 minutes candles. 22 pips is very, very nice if you have one lot. $220. For some people, that is the trading done for the day. You do that 5 times a week, it's $1,000. So this is what we've got to look at. Getting in, getting out. You know, this is all in the space of 1, 2, 3, 4, 5 candles, about an hour. So, you know, we made $200 in 1 hour. Who doesn't want to be on $200 an hour? I don't know anybody that doesn't want to be on $200 an hour. It's a great way to make a living, and this is why many people such as yourselves, you're getting into this, which is great. It's a wonderful strategy to use. I mean, looking at another one of my favorites, the gold. This is a 4-hour chart, and if we just look, going back to what Anton said about time frames, if you look at the weekly, I don't know about you guys, but I think that trend is pretty identifiable all the way back from 2012. I think we're downtrending, well, a tiny little bit sideways in this point, and then we're moving again to a downtrend. What I will do for you is I will put another trend line on here and join the peaks up here, and then I'm going to flip it down to I don't know, 15 minutes. And if we can see a few things, I just want to see where the trend lines are. Oh, they're quite high, so on this time frame it doesn't matter. But what I will be trying to identify is where is the bottom of where is the support here? Is it going to come down and touch the trend line, or is it going to use one of the supports? So on a 4-hour, this seems to be a nice support. We'll put another couple of supports on. You know, it could come down and find support around here. The reason I'm putting it here is because in this area here, you know, this was resistance. So I always look, one of my favorite sayings, and I'm sure Mr. Magda, Robert, and Anton, his friend, my favorite saying is always look left. You know, don't be a dummy and try to predict where the market's going to go, because you don't know. But I can tell you where it's been. And if you look at a weekly, you know where it's been. You can see that this is a channel forming on the trend line. On a 1 hour chart, you know, every time that the market breaks significant support, we have a breakdown to the previous channel. And what we're doing here is we're trying to identify where is the bottom of this channel. Nobody knows. I don't know. I'm sure you don't know. But using this strategy of Heikin-Ashi, we can look for an entry. So, you know, is it going to go up? Well, at the moment it's stuck in the middle of the range, 50%. It's $5 up and about $5 down, which is you know, it's hard to pick an entry. If I was looking at the using the Heikin-Ashi as a theory, then you know we had a cross here, but we didn't have any follow through with the candles. We had the first white candle, which means theoretically we are in a long trade already, which isn't a bad thing. But then we have to think about, okay, I entered long. What happens if I got it wrong and the market starts to go down? So if we got in here at 1146.98, then we have to think about where is our range going to be. It's not a currency, so we can't say 50 pips. So we have to pick a different amount because it's a different instrument. So maybe it's $5 buffer. It's a lot of money. Maybe we're going to make it $1. It's different things for different instruments. So let's see. So I'm going to leave it there for this week. I will answer your questions. Don't worry, Fakamisa. I know you want to look at the dollar Swiss, but I want you guys to just go away, take what I've said on board, and we're going to do review after review after review on this strategy. I'm going to add this video onto the website, onto the CM Trading website. You'll be able to view it. It's part of my YouTube channel, which I'm just building for the company. Take a look at the slides. Any questions that you have, I'll be happy to answer them for you. And we will do a follow-up in a week or two, and we'll do the next level. Maybe, you know, look at some different strategies or try to enhance this strategy. Even we'll do some live trading. So I'm going to leave it there for now. I want to thank everybody for coming. Just to mention a few names: Bongani, Ben, Denford, Dennis, Derek, Esther, Francois. As usual, you're a very regular attender. Anton, nice to see you here. And sorry we lost Gerhard at the end there. Maybe he needed to go and make a cup of tea. I don't know. But have a wonderful evening, you guys. I'm glad to have you with me. Company's glad to have you with us. Any assistance we can give you, it's a pleasure. You know, just mail me out. Video will be on YouTube, I promise you, tomorrow. Pause the slides, take a look at the slides. Try that one hedging strategy with the volume. If you need to know different volume levels, I have many, you know, 10s, 20s of different volume levels for different instruments. So have a wonderful evening. Thank you for attending. Take care. God bless, and have a good night.